sovereign debt crisis. These are three words that used to be associated only with emerging markets and developing nations, and only recently have people come to associate it with the coming future of the United States. As it stands, the US national debt totals over $33 trillion, and the debt to GDP ratio is 120%, the highest level since World War II. But things seem to be chugging along just fine. So the question is, when exactly will the United States debt issues actually become a problem? Well, the good thing is this isn't just guesswork. We're dealing with numbers here, so we can do some math. But before we do the math, we have to know that we're looking at the right numbers. So what is the most important metric to look at here? Well, if you're looking at your own personal financial situation, you may want to take a look at your net worth, so your assets minus your liabilities. You'd probably also want to take a look at your income versus your expenses. The combination of these factors would give you a picture of your financial health. If you have a positive net worth, meaning your assets are worth more than all of your debts, and you have positive cash flow, meaning you have more income coming in than your expenses, then you're probably sitting in a fairly okay spot. If, however, you have a negative net worth, meaning you sell everything to pay off your debt and you still owe some debt left over, and you have negative cash flow, meaning every single month you're spending more than you're making, so you're going deeper into debt each month, then most people would look at that as a disastrous financial situation that cannot continue in perpetuity. Now, if we take a look at the United States fiscal situation, this is the situation they're in, but they have one advantage over the rest of us. They're the government. And as a result of the United States government being a government, they have a monopoly on violence, which allows them to take any amount of money that they want in taxes, and then the additional money that they need left over, they get to borrow at below market rates, because at the end of the day, they can just go take more in taxes to pay that debt back should they need to. And if both of those methods still don't produce enough money for them to take, well, then they can just call on the Federal Reserve to purchase some of their debt so that they can borrow money from the Fed. These three methods of taxing, borrowing, and printing allow the US government to continue to increase their income to meet any expenses they deem necessary. And the only limitation on that is tipping over into hyperinflation, where people dump the currency and no longer want it, which means that the government no longer has the purchasing power that they used to. Countries like Argentina, Venezuela, Lebanon, Turkey, all recent examples of hyperinflation. We've had some Zimbabwe recently as well. Some older examples are places like the Weimar Republic in Germany, and even the United States before the Revolutionary War, when they printed the Continentals to fund the war. All examples of hyperinflation, printing money to pay for expenses that resulted in a collapse of the currency and a lot of economic pain. Now, some people like you and I want the US government to stay as far away from that as possible, while the people in control want to actually get as close as that to possible without actually tipping over. So the question is, where is that tipping point? Many people have pointed to debt to GDP ratios of 90% or 130% as the tipping point, where if you cross those lines, eventually things spiral out of control. But consider with me for a moment, if the interest rate on the debt, which means the cost of servicing that debt, is, let's say, 0%, then theoretically, the debt could be unlimited. It could be an infinite amount relative to GDP or any other metric, and it wouldn't matter. It may matter in the long run, but at least right now, adding on more debt at 0% interest rate that matures in, let's say, 100 years would obviously not impose any significant financial burden on the government. So in my opinion, there is a better metric to look at, and that is the interest payments, or the cost of servicing that debt, compared to GDP. Currently, the annualized interest payments on the national debt exceed $1 trillion per year. This is just an estimated cost, estimated by looking at the most recent payments and annualizing that. As of Q3 of 2023, the total interest payments in reality were $981 billion. If we take a look at the GDP for the United States, we are currently at $27.6 trillion. So let's do some math here. We're going to take a look at how much the US government is currently spending on its interest payments on the national debt. And we're going to look at how big that is compared to the economy, the GDP. The reason why we're doing this is because it gives us a gauge of how much the government has to take from economic output just to service the debt. This isn't for any of the other government expenses. This is just to pay for keeping the pile of debt that the government has. So we take $981 billion and divide it by 27 trillion, and we get approximately 3.6%. So the US government right now has to transfer 3.6% of the national GDP just to pay for the interest on the national debt, just to keep it. That's the debt servicing cost. Now, 3.6% may actually seem pretty low to you. So what does that look like in light of history? Well, as we can see from this chart from Bianco Research, interest expense as a percent of GDP, as shown by the green line on the bottom section of the chart, going back to the 1940s, is 3%. From about 2004 through 2020, the interest expense as a percent of GDP on the national debt was historically low. We can also see that during the years about 1980 through 2000, the annual interest expense as a percent of GDP was historically high. When we're close to 3%, that's about normal for the past 100 years or so. Anything above 4% is abnormally high. And as you can see, we have never exceeded 5%. Now, one thing that may stand out as a huge red flag to you when you're looking at that chart is this hockey stick at the very end that's going vertical. And if it continues at this pace, it will not be long before the US government is paying over 5% just to maintain the debt pile. Again, this is as a percent of GDP, the total economic output for the nation. And at the current pace of the interest cost on the national debt increasing, it looks like it's going to get into a very burdensome territory relatively soon. But can we calculate exactly how long it will be before we get there? Well, let's break out the crystal ball, or as I like to call it, the calculator. There are two things that we need to project forward here. One of them is the interest cost on the debt, and the other one is GDP. Obviously, both of these can change, but the interest cost on the national debt is a little bit easier to calculate because it doesn't just go up and down based on some uncontrollable factors. It's relatively predictable based on current interest rates and the debt load. So let's start there. As of Q3 2023, the interest payments on the national debt, $981 billion. Based on more recent payments, the annualized figure is a little over $1 trillion right now, but we can do a little bit better than that. If we take a look at this chart from ingoldwetrust.com, we can see that as of January of 2023, because it's one star here, so USA is as of January of 2023, we can see the breakdown of each country's debt load by maturity. These purple bars represent debt that matures in 30 or more years. The green bars represent debt that matures in 10 to 30 years. The blue bar represents debt that matures in 5 to 10 years. The gold bar represents debt that matures in 2 to 5 years. And the dark blue bar represents debt that matures in 0 to 2 years. So again, this is as of January of 2023. So as of the time of this recording, this data is already 1 year old. But as of January of 2023, in the United States, almost half, 44% of the US debt was going to mature in the next 2 years. So if we average this out, that means that during the year of 2024, we have about half of that left over that still needs to mature. But first, let's talk about why it's actually a big deal that we have so much debt maturing within the next 12 months. Well, if you take a look at the interest rates on government borrowing for 10 years, the 10-year treasury, we can see that we have to go all the way back to 2007 before interest rates were as high as they are today. This means that any of the debt that the US government borrowed during 2008, 09, all the way through to basically today was borrowed at interest rates lower than what they're borrowing it at today. If we take a look at what the United States national debt was, starting in 2008, it was only $14 trillion. So the US debt has over doubled, going from $14 trillion to $33 trillion during a time when interest rates were lower than they are today. So when we see a large percentage of the United States debt needing to get rolled over because it's maturing, it means the United States government is borrowing new money at higher rates in order to pay off old debt that was at lower rates. Currently, the interest expense as a percent of GDP is about 3.5%. But by the end of 2024, the total dollar amount of interest payments will no longer be $981 billion. It'll be closer to $1.2 trillion. We can find that number by taking a look at the total amount of debt that is getting rolled over by the end of 2024, looking at current interest rates, and then adding that total cost to what they're paying right now. Throughout the course of 2023, about 1/4 of that US debt was rolled over at around 5% interest rates, considering some of it was at the 2-year, 1-year, and shorter maturities. So even though it was probably a little over 5%, we'll just give them the benefit of the doubt. We'll round down to 5%. So we take 33 trillion, which is the total national debt, divided by 4 to get the total amount that was rolled over during 2023, and multiply that by 5%, and we come up with $412 billion. Assuming interest rates stay somewhat close to where they are right now, and the federal government continues to do what it's been doing, which is rely on short-term debt, they'll be rolling that over again a little over 5%. So we'll just give them the benefit of the doubt and say 5% for the next quarter of the national debt that will mature during 2024, which means we basically just need to multiply this number by 2 to get $825 billion as the total interest cost on half the national debt. The other half of the national debt will still have the lower interest rates because that debt hasn't yet matured. If we take the current interest payments from last quarter at $981 billion and divide that by the total national debt of 33 trillion, we come up with an average interest rate on the national debt right now of just about 3%, which means if we take the remaining half of the national debt that will not be rolled over by the end of 2024, so about $16 trillion, and multiply that by 3%, that means the remaining half of the national debt will have an interest cost of $480 billion. When we add back in the interest cost of $825 billion for the other half that will be totally matured by the end of 2024 and rolled over, get a total interest cost by the end of 2024 of $1.3 trillion. If none of that math made any sense and went completely over your head, don't worry at all. Essentially, all we did here is we looked at all the government's credit cards and we said, okay, you've got one introductory rate of 0%, one introductory rate of 3%, and those introductory rates are expiring. You're gonna have a new interest rate on all that debt. Based on the new interest rate, by the end of 2024, the US government is conservatively gonna be paying $1.2 trillion per year just to maintain the national debt. But let's be honest, if GDP grows extremely aggressively, then that won't be much of a burden. We have to compare it to economic output because economic output is what the government taxes from. That is the productivity that the government takes in order to redistribute or transfer wealth, line their own pockets, pay for these endless wars that all US citizens desperately want. But it is true that if GDP grows extremely aggressively, then that increase in the interest payments on the debt won't be that big of a deal. So what can we say about what GDP will do? Well, you probably are fully aware that I believe GDP will not be growing aggressively during 2024. I'm fully anticipating a decline in GDP during 2024. But let's assume that doesn't happen because in Q3 of 2023, the US GDP increased at an annual pace of 8.5%. Monster GDP growth numbers that nobody expected. In dollar terms, that was $560 billion, bringing our current GDP to 27.62 trillion. So let's assume that the United States GDP continues to grow at that same mind-boggling pace of $560.5 billion every quarter until the end of 2024. If we take $560.5 billion and multiply it by 4 more quarters, we get GDP growth of $2.2 trillion. If we add that to the current GDP of $27.6 trillion, you get a total GDP of $29.8 trillion. Okay, so now we can start to put these two things together. If we take a look at the interest cost, we know that it's going to increase to about $1.2 trillion or more by the end of 2024. It can't increase to less than that by much because the debt's gonna be maturing no matter what. It has to be rolled over. Unless interest rates come drastically down, we're going to see $1.2 trillion or more by the end of 2024 for how much the government's spending just to maintain the debt, just the interest cost alone. And if we see the economy, GDP increase increase at these blistering paces that it did in Q3, every single quarter for the next year, then GDP will reach $29.8 trillion. So how do those compare? What percent of GDP would that future interest payment be? Well, we have to take $1.2 trillion and divide it by the future expected GDP of $29.8 trillion, and we come out with 4%. So let's go back over to our handy dandy chart of interest payments as a percent of GDP and see where 4% lies. 4% is right outside of one standard deviation in which the interest expense as a percent of GDP becomes historically abnormally high and definitely becomes a burden on the economy. But I'd like to take this one step farther, because what if GDP doesn't increase next year? Let's not even say we get contractions. Let's just say GDP doesn't grow, because we know that the definition of a recession that is typically used is 2 quarters in a row where the nation's GDP falls. So let's just assume we don't even enter into a recession. We just stop seeing the unbelievable growth that we saw during Q3. Current GDP is $27.62 trillion. So if we take the future interest cost of $1.2 trillion and divide it by the current GDP of $27.62 trillion, we get 4.3%, which is well on its way to nearing record highs. Now, just for fun, let's see what it would take to hit a record. What would it take for the interest expense on the national debt to exceed 5% of GDP? Well, we could take the interest expense by the end of 2024 of $1.2 trillion and divide it by 5%. Well, if we're looking at current GDP of $27.62 trillion, 5% of that would equal $1.38 trillion. If we subtract the $1.2 trillion that we know we're expecting by the end of 2024, that leaves us with a difference of $181 billion in interest expense. If we divide that by 5%, the current average interest rate on government debt, in other words, an increase in the deficit by $3.6 trillion. During 2020, which is the record deficit in our nation so far, it hit $3.1 trillion. We did recover in 2022 to a mere $1.3 trillion, but as of 2023, we are headed back the wrong direction yet again. In conclusion, it does not look like the interest on the national debt will be an issue in the short run. It's not going to impact anything severely in the next 12 months through the year of 2024. Yes, it will likely push interest rates, especially short-term interest rates, higher. This is because as the government rolls over that debt, they're going to be borrowing short-term debt in order to pay off that old debt. All this additional supply of debt, all this borrowing is their demand for borrowing, which needs demand on the opposite side for lending. When that demand is not there, interest rates go up until the demand comes in. So throughout 2024, we are very likely to see higher rates as a result of the additional government borrowing we're going to be seeing. But a sovereign debt crisis unfolding, collapsing, tipping over into hyperinflation, threatening government defaults, those are not things that anybody should expect to see during 2024. These are very long-term issues, and even at the current pace that the interest costs are increasing by, it'll probably take closer to 2 years before interest payments reach a record as a percent of GDP. And even then, that's just when it becomes a larger burden on the economy, which helps push the economy closer into recession or deeper into recession. Don't get me wrong, things can spiral extremely quickly, but as of right now, it does not look like quickly means the next year or two. These things always take a little bit longer to unfold than most people think they should, especially the ones who are on the lookout and can see it coming. Now, there are 2 action steps, 2 takeaways from this that everybody should be considering. Number 1, how do I take advantage of these higher interest rates? Because most people look at it as a negative. Look at all of the increased cost on the debt. If I want to buy a car with a loan, if I want to buy a house with a loan, look how much this is going to cost me. Don't look at it that way. You should never be using debt to buy things. You should be using debt to buy assets, and only if it's fixed debt with a long maturity and the asset you're buying pays for more than the debt. Instead, people should be looking at how to take advantage of these higher interest rates. With valuations in the stock market at record highs, it just doesn't make sense to keep so much of an allocation in equities. It makes more and more sense as this persists to take an allocation of that and put it into things like T-bills or even money market funds. And the second way that people should be looking at trying to take advantage of the current environment is taking advantage of the declines in equity prices and asset prices. Any investor that thinks the only two options are buy or sell and stay in cash is not a sophisticated investor and will never be able to take advantage of those downside opportunities. Yes, it's possible to take advantage and make money when things are going up in price, but as the saying goes, people make money in bull markets, but make fortunes in bear markets. You've got to learn to play it both ways. And if you need help with getting out of debt, managing your cash to de-risk it and also get a crazy high interest rate, hedging your equities, or profiting on downside moves in markets, I teach active investors, hundreds of active investors every month to do the exact same thing through Heresy Financial University. Right now it's $99 per month. You get unlimited access to all of the training material that teaches you how to do exactly everything that I've just been talking about. We do monthly live streams where you can ask any questions that you have along the way, and your pricing is locked in as long as you are a member, but the price is going up starting January 2024. So if you want to lock in that $99 a month and grandfather that in, got to sign up now before the price goes up starting in 1 month. Link is in the description below. As always, thanks so much for watching. Have a great day.